Why UK house prices are falling even faster than expected is a question that has captured the attention of homeowners, buyers, investors, and policymakers alike. The housing market, long considered a pillar of economic stability, is undergoing a correction at a pace that has exceeded virtually all expert predictions. While early year forecasts anticipated a mild adjustment in property values of 2 to 4%, the reality is far harsher. Certain regions, particularly London, the South East, and the East of England, are experiencing year-on-year declines of 10% or more, while cities such as Manchester, Birmingham, Leeds, and Edinburgh report decreases between 5 and 7%. This rapid shift is not uniform. It reflects an intricate interplay of regional disparities, financial pressures, and shifting market sentiment, creating a landscape that is both volatile and unpredictable. At UK Property Info, our analysis draws from multiple authoritative sources including the Office for National Statistics, Nationwide, Halifax, estate agents, and property portals, revealing a market under pressure from a convergence of factors that extend far beyond interest rate changes or temporary economic fluctuations. The tightening of mortgage conditions is perhaps the most visible contributor to this accelerated decline. Interest rates, after years at historic lows, have increased significantly, altering the affordability equation for many potential buyers. Lenders have also become increasingly conservative, reducing the availability of high loan-to-value mortgages and tightening approval criteria. First-time buyers, who historically have been the most active segment of the market and the primary drivers of property turnover, are now facing significant hurdles. Many are being priced out entirely, forced either to delay purchasing, seek less desirable locations, or compromise on property size and quality. As borrowing becomes more expensive, overall demand decreases, placing downward pressure on prices and creating a scenario in which even slight reductions in interest rates may not be sufficient to reverse the trend without accompanying improvements in household incomes and affordability metrics. Beyond the numerical and financial implications, the psychological impact on both buyers and sellers cannot be understated. Confidence in the housing market has been eroded by a combination of economic uncertainty, inflationary pressures, and the specter of further interest rate increases. Buyers are hesitant to commit to long-term financial obligations in an environment where property values are perceived as unstable, while sellers, aware of declining valuations, struggle to adjust expectations quickly enough to match market realities. The result is a prolonged period of market stagnation, where homes remain on the market longer than anticipated and negotiations become increasingly protracted. This stagnation not only slows transactions but also reinforces a feedback loop. The longer properties remain unsold, the more uncertainty builds, which in turn depresses buyer confidence and encourages further caution on both sides. Regional disparities in the market further complicate this landscape. London, traditionally a bellwether for national property trends, exhibits stark internal contrasts. Prime central areas, heavily reliant on international investment and high net worth buyers, are witnessing sharper declines, with some luxury properties losing significant value due to a slowdown in foreign capital inflows. In contrast, suburban and commuter belt areas, while affected, are experiencing milder adjustments as affordability and demand remain relatively stronger. Regional cities such as Birmingham, Manchester, Leeds, and Edinburgh also display a patchwork pattern. High-end neighborhoods are correcting faster, reflecting their sensitivity to interest rate changes and reduced buyer confidence, while more affordable areas retain relative resilience. The north-south divide remains evident, with southern regions generally experiencing more pronounced declines due to higher starting price points, increased exposure to rate-sensitive buyers, and reliance on sectors affected by broader economic shifts. This uneven distribution of price movements underscores the complexity of the market and the necessity of considering micro-market dynamics rather than relying solely on national averages. The broader economic context also plays a pivotal role in accelerating the decline. Household finances are under considerable strain as the cost of living rises across multiple dimensions. Energy bills, transportation costs, groceries, and general expenses have all increased, eroding disposable income and reducing the capacity of potential buyers to enter the market. Even households that secured fixed-rate mortgages during the post-pandemic period are now approaching term expirations, facing sharply higher repayments that constrain both mobility and buying power. This financial pressure affects not only prospective buyers but also current homeowners, who may be forced to sell under less favorable conditions, contributing to further downward pressure on prices. The interplay between the sales market and the private rental sector adds an additional layer of complexity. Many landlords are exiting the market due to rising mortgage costs, increased regulatory requirements, and new taxation policies. This exodus reduces rental supply, driving rents upward, which in turn impacts prospective buyers who might otherwise have used rental periods to save for a deposit. Reduced rental affordability indirectly suppresses demand for property purchases, creating a compounding effect. Lower sales demand leads to price declines, which can affect investor sentiment and the availability of credit, further slowing market activity. Sellers who once anticipated a consistent stream of potential buyers from the rental pool are now encountering a smaller, more financially constrained set of buyers, further prolonging market stagnation. Investor behavior also contributes to the rapid decline. Institutional buyers, who historically provided a stabilizing effect on the market through large-scale acquisitions and portfolio investments, are adopting a more cautious stance amid uncertainty and the prospect of reduced returns. Individual homeowners who purchased property as an investment during the post-pandemic boom are reassessing their positions, sometimes resulting in distressed sales or preemptive price reductions. This withdrawal of liquidity exacerbates the downward trajectory of prices and reduces the overall resilience of the market. The psychological and emotional aspects of the current downturn are reinforced by media coverage, social networks, and word-of-mouth reports highlighting falling property values, failed transactions, and escalating mortgage repayments. Even prospective buyers with secure financial situations may hesitate to enter the market due to fear of overpaying or the possibility of negative equity. Similarly, sellers often preemptively lower asking prices, sometimes beyond what local market data would suggest, accelerating declines. This self-reinforcing cycle of perception and behavior significantly amplifies the speed and intensity of the market correction. In addition, long-standing structural vulnerabilities within the UK housing market exacerbate the rapid pace of price declines. Chronic underbuilding over decades, speculative investment cycles, inconsistent government policies, and demographic pressures have left the system highly sensitive to economic shocks. The current downturn, therefore, is not merely a cyclical correction but a structural recalibration. The convergence of these vulnerabilities with rising borrowing costs, affordability constraints, and market psychology has created a situation in which prices are declining faster than most traditional models anticipated. In conclusion, the accelerated decline in UK house prices is the result of a multifaceted combination of tightening mortgage conditions, rising living costs, weakened buyer confidence, landlord exits, reduced rental supply, investor caution, and long-term structural challenges. The market is undergoing a complex adjustment in which regional disparities, financial pressures, and behavioral dynamics interact to produce a rate of decline that has surprised both experts and market participants. At UK Property Info, our aim is to provide a clear, data-driven, and insightful analysis of these trends, highlighting not only the immediate factors driving the downturn but also the broader structural realities that will influence the trajectory of the housing market in the coming months and years. Understanding these dynamics is critical for buyers, sellers, landlords, tenants, and policymakers alike, as the consequences of this accelerated adjustment will continue to reverberate across the UK housing landscape. The second key driver behind the accelerated fall in UK house prices is the interplay between the rental market, investor sentiment, and construction activity. While much attention is focused on house prices themselves, the underlying dynamics of rental availability, landlord behavior, and new build development have profound effects on the speed at which property values are declining. One of the most significant pressures comes from the private rental sector. Many landlords, once confident in rental yields as a reliable source of income, are now exiting the market in unprecedented numbers. Rising mortgage costs, the imposition of higher taxes, and increasingly strict regulatory oversight have collectively eroded the financial viability of property ownership for small and medium-scale landlords. This exodus has led to a contraction in rental supply, particularly in high-demand urban centers and university towns, where rental properties historically played a critical role in maintaining housing market fluidity. As the rental stock diminishes, competition for the remaining units intensifies, driving rents higher and placing additional financial pressure on tenants. This, in turn, indirectly suppresses the pool of potential property buyers, as prospective purchasers are unable to save for deposits or meet affordability thresholds, further accelerating the pace of property price declines. Investor behavior is also a critical factor amplifying the market slowdown. Institutional investors, who once provided a stabilizing influence by acquiring large portfolios of residential properties, have become more cautious due to heightened market volatility and the potential for negative returns. The uncertainty around mortgage rates, economic growth, and regional disparities has prompted these investors to pause acquisitions or reduce exposure to residential property, withdrawing a significant source of market liquidity. Individual homeowners who purchased property as an investment during the post-pandemic boom are also reconsidering their positions, some selling preemptively to avoid being caught in further declines. This behavior results in increased supply on the market, often from sellers who are motivated rather than strategic, which depresses asking prices and accelerates downward momentum. The combination of declining investor participation and the release of previously held properties into the market creates conditions in which prices fall faster than anticipated, even in areas previously considered resilient. Construction and new build activity, traditionally seen as a stabilizing force, is contributing to uncertainty rather than alleviating it. Developers face rising financing costs, volatile materials prices, and labor shortages, all of which increase the risk and cost of new projects. Many planned developments are being paused, delayed, or cancelled, which reduces the influx of new housing units at a time when demand remains structurally constrained. The slowdown in construction impacts both the sales market and rental availability, creating an imbalance between supply and demand that amplifies price volatility. While insufficient new supply might be expected to support property prices in the medium term, the immediate effect is heightened uncertainty for buyers and sellers, with fewer options available and increased difficulty in forecasting future market movements. Buyers seeking new build homes are often confronted with elevated costs and extended timelines, while sellers struggle to position their properties competitively within a market characterized by both scarcity and declining affordability. The rising cost of living is another crucial element exacerbating the market downturn. Household budgets are being squeezed by higher energy bills, transportation costs, food inflation, and general increases in everyday expenses. Even homeowners with previously manageable mortgage repayments are now approaching term expirations, facing significant increases in monthly payments. This financial strain reduces discretionary income and limits the capacity to purchase additional property, directly reducing demand and putting further downward pressure on prices. Younger buyers and first-time purchasers are particularly affected, as stagnant wages and rising costs make it increasingly difficult to accumulate sufficient deposits or qualify for mortgages. The resulting affordability gap not only slows transactions but also amplifies uncertainty in the market, as buyers adopt a cautious stance and delay decisions in anticipation of further corrections. The regional dimension of these dynamics is particularly important. London, often viewed as a microcosm of the UK housing market, illustrates the complexity of current trends. Prime central areas, which rely heavily on international investment and high net worth buyers, are experiencing pronounced declines due to reduced foreign capital inflows and greater sensitivity to interest rate changes. Suburban areas and commuter belts, while also impacted, are experiencing less dramatic reductions as affordability remains relatively stronger. Regional cities such as Manchester, Birmingham, Leeds, and Edinburgh display a similar pattern, with higher-priced neighbourhoods adjusting faster than more affordable areas. This uneven distribution demonstrates the need to understand the market as a mosaic of interdependent local sub-markets rather than a single, homogeneous entity. Local economic conditions, employment trends, and demographic factors all play critical roles in shaping these regional outcomes, influencing both the pace of decline and the potential for recovery. Investor psychology and broader market sentiment are further amplifying price declines. Media coverage, social networks, and peer discussions focusing on falling property values and failed transactions create a self-reinforcing loop of fear and caution. Buyers delay purchases, anticipating further reductions, while sellers lower their asking prices preemptively to attract interest, often overshooting realistic market valuations. This behavioral feedback loop accelerates the pace of decline, demonstrating that perception and emotion can have as much impact on market dynamics as fundamental economic factors. The combination of reduced demand, shrinking investor participation, and cautious seller behavior creates a highly fluid and unpredictable market environment, where prices can decline faster than any model based purely on economic fundamentals might predict. The rental market's influence on sales cannot be overstated. With fewer properties available for rent, tenants are forced to allocate a larger proportion of income toward housing, reducing their ability to save for deposits. This delays transitions from renting to home ownership, reducing first-time buyer activity, which traditionally drives transaction volumes and supports pricing stability. Simultaneously, higher rents push some homeowners to remain in their current homes longer rather than seeking rental income through relocation, further slowing market mobility. This interconnection between the rental and sales markets reinforces downward pressure on prices and prolongs the market adjustment period. Finally, structural vulnerabilities in the UK housing system exacerbate these pressures. Chronic underbuilding over decades, speculative investment cycles, demographic trends, and inconsistent government policies have created an environment highly susceptible to shocks. When these long-standing weaknesses intersect with rising mortgage costs, affordability pressures, and behavioral responses from buyers and sellers, the result is a market correction that is not only deep but also accelerated. Understanding the interdependence of these factors is crucial for anyone involved in the property market. The current decline is not simply a cyclical adjustment, it reflects fundamental recalibration within a system that has accumulated structural imbalances over decades. In conclusion, the second major driver of the accelerated fall in UK house prices is the combination of rental market contraction, reduced investor activity, slowed construction, rising living costs, regional disparities, and psychological market responses. Each factor reinforces the others, creating a self-perpetuating cycle that drives prices downward at a pace exceeding initial expectations. At UK Property Info, we provide detailed, data-driven analysis of these trends, helping our audience understand not only the immediate pressures but also the structural forces at work. While the market faces significant challenges, awareness of these interlinked dynamics allows buyers, sellers, landlords, and policymakers to make informed decisions amid the uncertainty, and to anticipate how the housing landscape may evolve in the coming months and years. The third and final segment of our analysis focuses on the structural and policy-related factors that are amplifying the accelerated decline in UK house prices and the long-term implications for buyers, sellers, landlords, tenants, and investors. While mortgage conditions, living costs, rental market dynamics, and investor sentiment drive immediate fluctuations, it is the deeper structural vulnerabilities and policy challenges that create a market environment prone to rapid and uneven corrections. Chronic underbuilding over decades has left the UK housing market highly constrained. Despite periods of demand growth, new construction has consistently lagged behind population growth, household formation, and urban expansion needs. The shortage of supply has historically created upward pressure on prices, but in the current environment of tightening mortgage conditions and reduced buyer confidence, even limited supply is not enough to stabilize values. The structural mismatch between long-term supply constraints and short-term demand fluctuations creates instability, particularly in regions where prices are high and affordability is already stretched. Government policy and regulatory frameworks also play a critical role. Over the years, frequent shifts in taxation, landlord regulations, and incentives for first-time buyers have created uncertainty that impacts both market behavior and investor confidence. Landlords face higher taxes and stricter compliance requirements, while first-time buyers and low-income households struggle to access assistance that is often fragmented or inconsistent. The combination of these policy pressures has accelerated the withdrawal of private landlords from the market, reduced overall market liquidity, and heightened the pace of price declines. In parallel, prospective buyers are wary of entering a market where policy changes can directly affect affordability, taxation, and rental income prospects. The cumulative effect is a market environment in which uncertainty drives caution, and caution drives downward pressure on prices. Demographics further influence the current property correction. Household formation patterns, population migration, and generational shifts in home ownership expectations all play a role in shaping demand. Younger buyers, often burdened with student debt and lower wage growth relative to inflation, are increasingly delaying their entry into the housing market. This demographic reality reduces the pool of first-time buyers, the group that historically provides liquidity and supports upward price momentum. At the same time, aging homeowners who might downsize or sell to free equity are exercising greater caution, hesitant to move into new properties amid declining values. These demographic constraints, combined with affordability issues, create a scenario in which supply and demand are misaligned, accelerating the pace of price correction. Regional disparities remain a critical feature of the current market. London continues to lead headlines, with prime central boroughs experiencing pronounced declines due to reduced international investment and exposure to high net worth buyers. Suburban and commuter areas, while impacted, show relative resilience, highlighting the importance of location-specific market dynamics. Regional cities such as Manchester, Birmingham, Leeds, and Edinburgh also demonstrate uneven outcomes. High-end neighborhoods, particularly those with historically rapid appreciation, are correcting faster than more affordable districts. This fragmentation illustrates that national averages can mask local realities, and buyers and investors must understand specific micro-markets to navigate current conditions successfully. The impact of media coverage and social perception on the market cannot be overstated. Reports of declining property values, rising mortgage costs, and rental pressures circulate widely through news outlets and social media, creating a feedback loop that influences behavior. Buyers delay purchasing decisions, anticipating further price drops, while sellers adjust asking prices preemptively, sometimes beyond what market data would justify. This psychological component accelerates the speed of declines and reinforces volatility, demonstrating that market sentiment is as influential as underlying financial or economic factors. The broader economic environment also shapes expectations and behavior. Household budgets are increasingly strained by rising living costs, including energy bills, transportation expenses, and inflationary pressures on everyday items. Even households with previously manageable fixed-rate mortgages are facing renewed financial pressure as terms expire, leading to higher repayments. This financial strain reduces disposable income available for housing and makes prospective buyers more cautious, further limiting transaction volumes and amplifying downward pressure on prices. Investors and developers, responding to these constraints, reduce activity or delay projects, which in turn affects supply dynamics and contributes to ongoing market uncertainty. Construction and new build activity, once considered a stabilizing factor, has also slowed due to labor shortages, rising materials costs, and higher financing costs. Developers are postponing or canceling projects, reducing the supply of new homes at a time when overall demand is softening. While this supply contraction may support prices in the medium term, it contributes to immediate market uncertainty. Buyers face longer waiting times and higher costs for new properties, while sellers compete in a market constrained by both affordability challenges and delayed supply. The combined effect is a market characterized by heightened volatility, regional disparities, and downward momentum that exceeds previous forecasts. Investor sentiment continues to evolve in response to uncertainty. Institutional investors, who historically stabilized the market through portfolio acquisitions, are becoming more selective, pausing or reducing investment in residential properties. Individual investors, especially those who purchased post-pandemic, are reassessing positions in light of declining values, affordability pressures, and higher interest rates. Distressed or preemptive sales from these groups introduce additional supply, further accelerating declines. The withdrawal of these buyers reduces liquidity in the market and creates an environment where price adjustments can occur more rapidly than anticipated. In conclusion, the faster-than-expected decline in UK house prices is driven by a combination of structural, economic, and behavioral factors. Chronic underbuilding, regulatory uncertainty, demographic shifts, regional disparities, rising living costs, investor caution, and psychological market responses all interact to create conditions in which prices fall more quickly than traditional forecasting models predicted. At UK Property Info, our goal is to provide comprehensive, data-driven analysis of these developments, helping viewers understand both the immediate pressures on the housing market and the longer-term structural challenges that will continue to influence prices. While the current market presents significant challenges, informed insight, careful planning, and awareness of regional dynamics can help homeowners, buyers, investors, and policymakers navigate this period of volatility with greater clarity and confidence. Understanding these forces is essential not only to anticipate future trends but also to make strategic decisions that balance risk, opportunity, and long-term financial stability in an increasingly complex UK property landscape.